Good morning, everybody, and welcome to our Grand Rounds event. It's our pleasure that Wall Street Alliance Group, it's a fiduciary financial planning, advisory planning. It's specialized in financial planning for physicians. We have a great speaker among us, Mr. Syed Nishat, who is a partner at Wall Street Alliance Group. Syed's articles and interviews about asset protection and common financial mistakes by physicians were published in Medscape, Medical Economics, and MedPage also. He is regularly quoted, interviewed in Forbes, US News, and he also is a 401k specialist. So all the viewers, I have Mr. Syed Nishat, and I'm going to ask him to start his presentation. And Dr. Inderpal Chhabra is going to be our moderator. We'll be asking questions to Syed.
Thank you, Dr. Malhotra, for inviting me, and thank you, Dr. Chhabra, for being the panelist host in this event. And first, I want to start by thanking you and all the physicians, including the member of RPQLI, for their hard work and sacrifice during their pandemic. We at Wall Street Alliance Group provide wealth management solution for physicians across the United States. Now, taxes obviously is a big issue for physicians is because they're usually in a high tax bracket. And Biden administration recently proposed almost a $2.3 trillion infrastructure bill. Usually, whenever you pass such a huge bill, there's a budget deficit and there's a big question who's going to pay for the bill. And most of the time, the simple answer is by raising the taxes. Now, people who are making more than $400,000, they will be affected the most. And it is not uncommon for physicians to make easily $400,000, especially if the husband and wife are both working. Now, I would like to just share my slide with you just to give an idea how the tax planning looks like and how does it affect all of the physicians. So there's a lot of variance in this bill, but the two important aspects you have to take a look. If you can see all my slide, if your earning is more than $400,000, the top marginal rate goes up from 37% to 39.6%. So it's about 3% close to jump. So you might say, okay, it's a 3% jump, not a big deal. But there's one more caveat to it that as an individual, we do not pay Social Security tax after the income over $140,000. That's the maximum income we pay Social Security in. If your income is more than $400,000, the proposal is to increase the Social Security income for everyone. You have to pay additional 12.4% Social Security for any income more than $400,000. That's a big tax you have to worry about. And lastly, small businesses, they actually have different itemized deduction they can take. You can have a standard deduction, you can have itemized deduction. So if your income is more than $400,000, the proposal is the itemized deduction start to phase out. Now, just in case, if your income is more than $1 million, we're looking at a long-term capital gain and dividend tax to go up from 20%, which is approximately right now, to almost close to 39.6%. And last week, as the news came in Bloomberg, the Biden is actually doubling it down to tax rate to almost close to 43.6%. For any stock you hold on to for more than 1 year, usually you pay long-term capital gain tax, but now you have to worry about paying almost close to 43% capital gain tax. So ideal situation is that look for some vehicle where you can actually put money and lower your income overall. So just in case if the bill gets passed, it doesn't affect your overall tax burden too much. Now, beside that, I would like to talk about one more Biden's bill, which is not part of the infrastructure bill, which is called the 401k tax deduction. And it is very popular into the 401k community. When you contribute into a 401k plan pre-tax money, usually you get an upfront deduction. If you look at my slide, for example, if your income is $400,000, you are usually in about 33% tax bracket right now. Over the age of 50, you can contribute about $26,000 pre-tax money in the 401k. So if you're in a 33% tax bracket, we're looking at a tax saving of close to about $8,500. what Biden administration is saying, high income earners, because of their high tax bracket, get a huge tax deduction. What about someone who's making $40,000? They are not in a 33% tax bracket. They are in a much lower tax bracket, maybe 10 to 15%. They contribute into the 401k. They don't get the huge tax credit. So what Biden is proposing is rather getting an upfront tax deduction, replace it with is called flat tax credit for everyone, regardless of your income level or your tax bracket. The census is 20% credit for everyone, whoever contributes into the 401k. So for example, the same example, if someone is making $400,000 contribution at 26,000 into the 401k pre-tax, you will get a tax credit of $6,700 approximately in your tax return. So the good thing is, if someone is making 40,000, contributes $10,000, for example, he will get almost 26% tax credit as well. The issue is going to be that 401k may not be that lucrative for physicians anymore, because if the upfront tax credit goes away, their tax credit is much lower than their individual tax bracket. So we do see a renewed interest into the Roth IRA or cash balance plan, is because the 401k, if this law passes through, will be less attractive for physicians. So, but the most important right now to just focus on what are the vehicles out there physician can use, talk to their CPA about, so they can overall lower your income, ideally close to below 400,000, because those are the individuals will be affected the most.
So we have a question, a couple of questions that popped up. Is the $400,000 earned income, or is it income from all sources?
It's income from all sources. Okay. So that also include the dividends you're collecting, rental income you're collecting. It's just not the earned income of W2 now. It's including everything.
Okay, good. And then we have another question that popped up in the Q&A section. I think that pertains to estate planning. We're going to come to that later on in the presentation. Mm-hmm. So basically, you touched upon some solutions depending on, I guess, an individual physician's position, monetary position. The difference between a SEP IRA, Roth IRA versus a cash balance plan. What are the differences? Maybe you can elaborate on those.
Yes. So still, we believe that the retirement account is the one of the best way to lower your overall taxes. Because if you contribute, let's say, $10,000 into a retirement account, and if you're in a 35% tax bracket, you immediately save around $3,500 taxes. There are different types of retirement account out there, but just to give you an idea how a cash balance plan works, if you're a self-employed physician and you are 60 years old, in a cash balance plan, you can contribute almost $260,000. And this money is completely tax deductible. Now, remember the previous slide, we spoke about the 401k, it will be replaced by tax credit. There's nothing mentioned about cash balance plan or a defined benefit plan. So that so far is untouched. So we see there's a renewed interest in the cash balance plan as well. Beside the 401k plan, you can also contribute into the SEP IRA plan as well. In a SEP IRA, as a self-employed physician, you can contribute almost close to $57,000, and this money is completely tax deductible. And IRA account, simple, basic IRA account, husband, wife together, you can contribute almost $7,000 each over the age of 50. Again, this money is completely tax deductible as well. And a lot of physicians, Dr. Chhabra, through hospital, they have high deductible health insurance.
Right.
So HSA account is a good way to defer money. And the good thing about HSA account, after the age of 66, you can just take the money and use it for non-health reason as well. So it's actually a supplement for retirement account. A lot of people are not contributing to the HSA, and usually physicians are already healthy. So go for, if it's all possible, depending on your situation, high deductible health insurance, and fund almost $7,100 for your family. And this money could be used for retirement account after the age of 66 as well.
So yeah, you're right. There's a lot of physicians, a lot of people, not just physicians, who don't really exploit the full benefits of a HSA account. And that's been, like, if you look at from a tax planning purposes, it's a very good vehicle from what I've learned over the last few years. But it's very difficult to convince a lot of people about high deductible plans. They still feel in the cash transaction like, okay, why do I have to pay money if I already have a health plan? So yeah, the thinking has to evolve, I guess. And then there's another question that popped up. The Social Security income on over 400,000, only be on earned income or all income?
Yeah, I think we asked this question. Yeah, it's going to be the all income altogether.
Right. And then when is this being promulgated? Is it this year, next year? This
Yeah,
plan, is
so
this a proposal or is it has been passed already?
no, it's just a proposal, and they want to pass it as soon as possible, effective this year. Is obviously because, if the infrastructure bill is basically everyone wants to get passed, both Republican and Democrats, because
Right.
that will create a lot of jobs, but there'll be a big hole in a budget deficit, and they have to be completed as soon as possible. So we don't know when, but they're very vocal about passing this, increasing the taxes as soon as possible.
Okay. And then there's actually questions coming up in the chat box also. So if you contribute to both a 457B and a 403B, would you be entitled to tax credit for both under this new plan?
Yeah, so it's a 26% tax flat credit. So as of right now, because these are new proposal, no one mentioned about 457. That plan is a non-deferred compensation plan. And I'm going to mention to you, the main talk about is a 401k and 403b. As the new designations are coming in, we will definitely keep you updated whether the 457 are also included or not.
Okay. Alrighty. So moving on, are there any other tax deduction vehicles besides a retirement account that you can enlighten us about?
Sure. So, and one more thing I just want to mention that we spoke about so far self-employed physician, but just in case physician who are hospital-based, they should definitely max out their 401k and 457 plan. And a lot of physicians are not aware of it. A lot of hospitals offer there's something called 409A plan.
Mm-hmm.
So 409A plan, it is similar to a 457 plan, but the deferred limit is much higher. It can go as high as almost 90% of your W-2 wage. So it is not offered by all hospitals, but some hospitals we do know they offer it. The problem with the 409A plan, similar to 457 plan, if the hospital filed for bankruptcy, the money is part of the proceeding. So it's not like 100% like 401k, which is ERISA protected. But we're not saying put a lot of money into it, but if the hospital does allow it, make sure you talk to your CPA and financial advisor if a 409A and 457 makes sense or not. And lastly, Roth IRA, we still believe is one of the most underutilized strategy in the physician community. A lot of physicians are not doing it because they want upfront deduction. But backdoor Roth IRA, everyone very much can qualify, regardless of their income via backdoor Roth IRA. So in a backdoor Roth IRA, what you could do that you open a post-tax IRA account. Husband, wife, both can contribute around 7,000 each over the age of 50, and immediately flip the money to a Roth IRA. There is no taxes due on the principal, and since you're moving the money immediately, the taxes on the gain will be very minuscule. But the benefit is once you move the money to the Roth IRA, the money grows tax-free, the withdrawal is tax-free after the age of 60, and after 5 years, you can use the money for qualified expenses as well. And I was talking to a client of mine, Dr. Chhabra, who is in New Jersey, is a physician. We did the math, 50 years old, contribute husband, wife together, $14,000, 20 years, 7% growth happens. The money becomes almost 600,000 and it's tax-free. So the value of compounding is very strong and everyone is talking about pre-tax, but I think that physicians who work for the hospital, as long as they don't have any IRA account open, 401k doesn't count. IRA account counts towards the conversion. As long as first time they're doing it, they can open a post-tax IRA and convert it immediately to a Roth IRA and defer money in taxes as well.
Okay, that's very interesting. That's very good to know. Let me just take a look at if there's any other questions. What is the limit for HSA for either for physician couple?
Yeah, for the family, 7,100.
Okay.
The max.
Okay. And then for those of you who don't really know a cash balance plan, can you elaborate on that? What is a cash balance plan?
Yeah, so cash balance plan, it is an employer sponsored plan. So if you work for the hospital, but let's say you have your own locum practice, it's not uncommon for a physician to work in a locum. And if you have, let's say, either 1099 income or self-employed income, you can contribute into a cash balance plan. The limit for cash balance plan is much higher. With a salary of $290,000, you can contribute lifetime around close to $2.8 million to $3 million ballpark. That's the maximum you can contribute. Husband, 2.8 million, wife makes 290. self-employed income 2.9 to 3 million each. It is an actuarial calculation that's determined how much contribution you can make. So the only difference between SEP IRA and cash balance plan, there's an actuary involved into it. You have to pay to the actuary, and every year the amount is determined by the actuary, and you calculate, and the money is completely tax deductible. And we as a financial advisor can sit down with you, look at your income, and let you know how much you can contribute into a cash balance plan.
Okay.
Okay.
So there's another question that popped up earlier. Vinny, this is your question. Prediction of tax trends in the future. If tax rates are going to go up in the future, retirement tax deferred plans may lose money overall. Any comments on that?
Yeah, if that's a very good question and a good analysis, that if overall taxes goes up, now the whole idea of contributing into a retirement plan, right now you're in a high tax bracket. Remember, you have to pay taxes in retirement account anyway, right?
Right.
So once you retire, the idea is hopefully your tax bracket will be lower, and you withdraw the money and you save the money in taxes at that time, and the money grows tax deferred. But whoever asked the question is right. If the tax keep going higher, then you will be taking the money out in a high tax bracket at the time. So what is a better solution? But still, we believe that tax deferred growth in the long run will have more values, and that probably will catch up. Because remember, if you don't contribute, let's say I'm giving a hypothetical $100,000 into a retirement plan, if you take home money after tax, you will get 70,000 because 30,000 goes in tax. But if you contribute the same 100,000, it stays in a retirement, you pay no taxes on it. So do the math, 70,000 growing versus 100,000 growing. 100,000 is ahead of the game usually, because it's a tax deferred growth. That's the whole idea. But he's right. If the taxes keep going higher, tax deferred may not be a good idea.
Right. Okay. And what's the new limits for defined benefit plan?
Yeah. So the defined benefit plan and cash balance, the new limit by looking at the interest rate, around 2.8 million to 3.2 million. That's the range.
Okay. And then if you already have a defined benefit or a 401k plan, can you still add an IRA for the backdoor IRA, Roth IRA?
So if you have a 401k, if you have a cash balance plan, you can still do the backdoor Roth IRA.
Okay.
It's a post-tax money.
Alrighty. And then there's another question from Rakesh. Surely only income over 400,000 is tax higher under Biden plan. Please be clear.
So basically what happened if the net effective tax rate right now, if the income is, whatever the income threshold is, you pay around close to 37% in tax. That's the high tax you pay. But if the income goes up more than 400,000, overall tax, effective tax will go up to close to about 39%. Plus any income more than 400,000, that income, we're talking about additional Social Security tax, about 12.4%. That's what the proposal is. If the income is more than $1 million, capital gain tax goes up overall. Any real estate sale you do, any dividends you collect, about close to 43%.
Okay. And what if the growth of cash plan exceeds 3 million?
Okay. So if the client plan growth, so total lifetime limit is a very good question. Grows, you can freeze the plan. One option is, because remember, with inflation, the limit keeps going higher. Right now is 3.2. It will keep going higher with inflation, number one. Number two, if the asset freezes, there's no benefit gets accrued, number one. And number two, if the assets goes up, let's say from 300 goes to 3.1 million, you can open up a profit sharing plan, 401k profit sharing, and transfer money from the cash balance plan to the profit sharing plan. And indirectly, the amount goes down. You're not going to get the deduction, but I guess the question is that how do you salvage the overfunding? There are various ways of doing it. You can add your wife in the payroll, contribute for her. That will leverage the problem you're facing.
Okay. And why is Roth IRA underutilized? What do you think is the reason?
Because a lot of physicians, it involves some paperwork. You have to open a post-tax Roth IRA. You have to open a post-tax IRA. Then you have to open a Roth IRA. And then you have to, move the money from the IRA to the Roth IRA. It's a lot of paperwork for physicians and financial advisors. But if a fiduciary financial advisor have no conflict of interest, they will give you the best advice possible.
Okay. And then another important question, like after retirement, should a physician move to a tax haven state like Arizona or Florida or someplace like that?
We're already seeing it. They don't have to retire.
Yeah.
We're already seeing from New York, people are moving from New York to Florida and Texas, Nevada. We're seeing it because there's no estate taxes.
Alrighty, excellent.
But tell us for estate planning about the Secure Act or something new which has come up.
Yeah, sure. So I just want to touch bases very real quick, if it's okay, about beside the retirement planning, what are the vehicles out there the physician can save some money, if it's just okay with you. I just want to very quickly touch bases. So if you take a look at my slide here, that a lot of physicians, it's not uncommon for them to invest into real estate, especially in New Jersey area. We see everyone invest into real estate. Prices are going up. So when you try to invest into real estate, try to take a look into something called an opportunity zone. Opportunity zone are the areas where there's at least 20% poverty rate. In an opportunity zone, if you buy the property, hold on and for 10 years, there's no capital gain on it. That's the beauty of it. So we see since 2017, there's a lot of interest in it. And number two, cost segregation is extremely important for physicians who have their own practice. It's very common in my business, physicians to have their own practice, pay themselves a rent. That rent is part of your income. Cost segregation, what it does, it gives you advanced depreciation. Just to give you an idea, I have a client recently purchased an office for about $1 million, and we did a cost segregation study. So usually what happened is that any commercial unit you have it is a 39 years scheduled depreciation. For any commercial unit, you have it. Cost segregation, all it does, lower the depreciation from 39 years to 5 to 7 years. In this way, you get more depreciation. This amount you can use to write off any active or passive income from that real estate. So going back to my client's example, he bought a property for $1 million. We did a cost segregation study. Immediately, we get a $250,000 advanced depreciation. And any income the client received, active, passive from this property, we can get to write off from the study we have done it. So again, if you have your own practice, if you do a lot of commercial real estate cost segregation, take a look into it. It will save you some money because you're in a high tax bracket right now. And then very briefly, I will just touch bases because this itself is a webinar of its own, which is like, a lot of physicians we see, they give gift, like APQLI or different organizations you're giving gift. Rather writing a check, if you have appreciated stock, give that as a gift via a donor fund. The reason will be that when you, the whole stock, you pay no taxes in it. That's extremely important. And number two, that those who are over 72, pretty soon you will be taking a required minimum distribution. If you're charity minded, give money directly from the retirement account to the charity. In this way, you don't, the income is not going to be part of your adjusted gross income, and also your RMD will be met. And lastly, if you want to get income from a charity, consider charitable remainder trust as well. But again, these are some advanced topic. It's not part of this whole webinar. We can talk separately, individual about it, but these options are also available depending on your circumstances. Now, I want to talk about really quickly, the Biden state tax. In America, there's something called income tax. There's something called death tax. So the good thing is you don't have to worry about this death tax or estate tax unless your net worth is more than 23 million. Well, the bad news is the Biden administration is not only vocal about increasing the income tax, but also reducing the estate tax exemption as well. And so far, the proposal is that 3.5 million. If your net worth is 3.5 million, husband, wife together, 7 million, any net worth more than that, you die, your heirs have to worry about paying something called estate tax, which is as high as almost 44%. Now, what are the solution for it? And physician, it's not uncommon that during retirement, they have at least this much worth of a net worth. One solution could be that you still have time to give gift to your children via an irrevocable trust, almost 23 million if you want to. 11 million each, you can give gift. And the beauty is the money will go estate tax free if you want to. You don't have to give all of it, but whatever you want before the law changes, number one. Number two, every year, $15,000 per child. Per parent, you can give almost $30,000 you can give each children. You don't have to worry about paying any gift taxes every year. And again, this is out of your state. If your state is very big, nothing you can do. So what you can do, you can buy something called a life insurance policy, second to die life insurance policy. They're very cheap. It's a paid up policy usually. You can just buy it, and whatever the state tax will be due, the life insurance can pay for it. And if you own a life insurance right now, and if your state is more than, let's say, 7 million, a lot of people think life insurance is state tax free. It's not, it's income tax free. But if you die, if the life insurance death benefit comes to your state, if the state is more than 7 million, for example, if that's the limit, you have to worry about paying state taxes. So if that's the situation, you can create a irrevocable life insurance trust and move the life insurance in the name of the trust. So in this way, the death benefit is not part of the state. And lastly, I will just talk about the charitable remainder trust. I mentioned where you can get income for yourself. If you die, one option could be some portion can go to the charitable remainder trust, and the beneficiary actually can take money as an income as well. So again, these are all the solutions that are available. I just want to highlight it, not necessarily provide the exact solution, but physician can speak to their financial advisor which one is applicable for them from a state tax point of view.
So I guess it's all going to be customizable, like depending on each and every person's situation. And one of the questions that came up is the gift tax dependent on the child's age?
The gift tax. So the gift tax, for example, if you give more than $15,000, $30,000, it is under you. You have to pay gift tax.
Okay.
Yeah.
Maximum you can do 30,000.
Yeah, 15,000 per parent. 15, 15, 30.
Okay, all righty. And there's another question, with the general overall question from Dr. Kakani. Is there a formula retirement? When does it make sense to move to Florida from New York? Is there a magic number?
Well, so in New York City, I mean, we see a huge people are outflow from Florida is because you immediately save around 8%, in New York City tax that additionally you have to pay. So the magic formula is move. Honestly speaking, if you're retired, so that's why a lot of retirees actually is in New York City. They are moving out. So the magic formula becomes that you have to put in consideration the happiness in life. Are you happy? Don't just move to. If all your friend Dr. Chhabra, I think, is here. If you move to Florida now, you'll be very depressed and unhappy.
Yeah,
might as well just stay here.
Yeah, absolutely.
Yeah. So it's very hard to put a magic formula in it.
Right. So then the question about the child of the child's age was, can you do the gifting to even adult children, or do they have to be under a certain age?
No, you can give it to adult children too. So it's a per child 15,000.
Okay, all right. And then there's another comment: if you sell that property in less than 5 years, then you have to pay all the taxes, right?
No, it's not about. So I think the question is the cost segregation I mentioned.
Right.
Someone is asking that. So it's not about 5 years or 2 years. So remember, depreciation is lowering your acquisition cost of the property. So cost segregation is advanced depreciation. So let's say the client, I'm giving the example, for $1 million, we did a cost segregation. Now his cost basis is $750,000. So anytime he sells it, obviously his cost is lower now. He needs to pay taxes. So the idea is that you should own the property for long enough. If the idea is to flip it, cost segregation doesn't make sense. It's only for long-term property it makes sense. Also, you can do something called a 1031 exchange for property as long as you do it. I mean, there's no taxes. Yeah,
that's what I was. I've been unfamiliar with the 1031 exchanges for real estate. A lot of people who dabble in real estate, that's what they look for. They look for the next deal before they sell some property.
Right. But the long term, you're saying you should be at least 5 years. You need to hold on to the property.
We would like to see the property hold on to it for 6, 7 years at least. To get the write-off and everything. And then there's a cost involved in cost segregation. It costs between $3,500 to $6,000 to $7,000, depending on the size of the property. So it does have to make sense. So if you just bought it in a few years, you flip it, what's the point of doing all of this?
And did the cost segregation plan did change with Biden new law? Or
as of right now, it's untouched.
Okay. Alrighty. So going back to the basics, so given that new changes are coming, can you give some basic idea of why estate planning is important? Like for some people who may not understand the whole thing. So let's start from the basics.
Yeah, so the very basic, Dr. Chhabra, estate planning is one of the most important but neglected aspect of financial planning. And especially for physicians because they are the hardest hit during the pandemic and you guys are in the front line. Right. And I was reading an article in Medscape that last March came in that over 450,000 people on the front line, they got affected in COVID-19, and over 3,000 physician and frontline worker died.
Yeah.
One of my best clients recently passed away battling COVID-19. And I cannot imagine this client is not having a basic will and trust. Just to give you an idea, if this client didn't have a will, something as simple as the custody of the children would have been decided by the US government. And now we have to worry about fighting in the court to get this asset because it would have been get stuck in a lengthy probate process. I'm glad my client had the foresightedness to get the estate planning done. And like it or not, life is very fragile nowadays, especially if you're a physician. So that's why all physicians like my client should get their estate planning done as soon as possible.
Okay. Alrighty, so that's good to the basics, and then you can give us some idea of like the recent changes like Secure Act or something like that I've been hearing about. So what should physicians be aware of? How should they proactively plan for it?
Yeah, so one thing, this is not a Biden law, this is a Secure Act, which a lot of physicians are not paying attention to. I think it's very important. That's already a law though, since last year. So before, and this is part of the estate planning, so that's why I think it's important to talk about it. So previously, if you die and you leave the money IRA account to the children, they can slowly start taking money out from the IRA account. It's called stretching. So let's say, for example, if you leave the money to your child who's 25 years old, they don't have to take the whole money out immediately. They can, take slowly the money out called required minimum distribution every year and stretch it like 50, 60 years, depending on the life expectancy slowly. So you pay less taxes and the money grows as well. So that was a good thing. That's called a stretch IRA. That went away last year because of Secure Act. Secure Act means called setting up for the whole community up for retirement in Act. That was passed actually last year. According to the Secure Act, money passed to children who are non-minor after wife passes away as well. Now that child has to exhaust the money within 10 years. So previously, throughout his life, now within 10 years, you have to just use all the cash. Just to give you an idea, like before Secure Act, physician, if you leave $5 million IRA to a children, life expectancy slowly takes the money out. With Secure Act, $5 million, you leave it to the same child. If you look at my slide, that child has two options: take $500,000 every year in 10 years, finish it, or at the end of 10th year, take all $5 million out. Well, what's the problem? The problem is that they have to worry about paying a lot of income tax. It's like $500,000 per year. I mean, and for physician is very, very big issue though, because most of their funds, especially if you're working for the hospital, they are physicians. They're not always business minded. They put every their nested egg in 401k, most of them. So, and if the 401k or defined benefit is very common, same issue prevails there. They have to worry about paying a lot of taxes, the heirs. So something has to be done, that a huge amount of income taxes that is due to Secure Act. So something has to be done about it, and speak to a financial advisor and CPA now to get prepared for it, because this is already a law.
Okay. All right, good. Let me take a look at some of the questions. Going back to retirement, is there a certain percentage of retirement that should be in Roth, or what's the maximum allowable?
Yeah, so we would like to, the way the financial planning works, we usually you sit down with a financial advisor and they come up with a plan for you that when you retire, how much money is getting in taxable, how much money is non-taxable, because the beauty of Roth IRA, there's no taxes when you take the money out. So depending on how much income you need, but ideally we would like to see a good chunk is tax-free. The more tax-free is better for physician nowadays, I'm talking about. So that's why we would like to see that more of a Roth conversion, more of a tax-free income. There's any way of doing it. So ideally, to answer your question, I don't have the exact science to it, but it all depending on how much is the tax liability when you retire.
So like all big questions in life, it depends.
It depends, correct.
Okay. All right. So the first question that was asked in the Q&A is about your primary residence. Should you put that in a trust?
So these are, yes, you can. The question was the purpose. So if the purpose is giving that as a gift anyway to the children, you want to do it, then yes, the primary residence, you can give it to the name of the children. just make sure the provisions correctly, you don't want your children to kick you out tomorrow. So the provision should be there. So something called a spousal access provision trust there, that your wife can take money out and she has control over it as well. So the whole idea is gifting to an irrevocable trust. You still maintain control indirectly. So as long as it is set up correctly, yes, you can do it if your net worth is substantial enough to do it.
Okay. Alrighty. And then another question about the gift to the children. Are grandkids allowed, or is it just children only?
No, grandchildren too, absolutely.
Okay.
So it's 15,000, yeah.
Okay. And then for tax planning and estate planning purposes, like, can one spouse be in Florida, a resident of Florida, or both have to be residents of a tax haven state?
Both needs to be, unless you file separate tax filing, but most of the people are filing together.
Alrighty.
So I just want to then, if you no question, conclude some of the solution for Secure Act.
Right.
So few solution for the Secure Act, as I mentioned, that Roth conversion, you can do it. So Roth conversion, what I meant by that, backdoor Roth IRA we spoke about, the 401k you can convert into Roth 401k. You can convert into IRA as well if you want to, number one. And the idea is that when the benefits take the money out, when the heirs take the money out, they don't pay any taxes on it, number one. Usually, like you ask a question, what percentage should be into Roth IRA versus IRA? Usually we tell people that take money out from Roth IRA first when you retire, then your brokerage account, sell it, then your cash account, last you touch IRA, because then you have to pay taxes. Because of the Secure Act, one option could be you can use more money from the IRA account and use it for yourself, and leave the Roth IRA for the children, depending on your net worth. And then, like you mentioned, that the grandchildren. So remember, the Secure Act only applicable for child who are not minor. So who are minor, one option could be, let's say, giving an example, if you have a grandchild, you can just, rather giving it to your children, give it to your grandchild some money of the retirement account. So that child can stretch it out, whoever is the grandchild, until the child turn 18. And again, 10 years start to kick in. That could be one more example as well. Again, you can buy a life insurance. That's a simple solution that can, if you're healthy, that can pay for it. Cheap second to die life insurance policy. And do more QCD means that, again, if you're charity minded, give more money from the IRA account. So in this way, you exhaust the IRA money quicker if your IRA is huge, so big. Or it could be combination of all of it, either or. There's no exact solution for it. So, but again, speak to your financial advisor. Some solutions are available for it.
Okay. All right. So
I have a question. Tell us, with COVID thing, as you know, has affected a lot of physicians last year. So, a lot of behavioral changes. What is this Kevin MD? I was reading about your article thing. Can you explain that, what it is?
Yeah, so basically, Dr. Malhotra, last year, we do financial planning for physicians with the hoping that none of this becomes true. Like, I'm hoping that you don't become disabled. I'm hoping that, no one dies. But last year, the big issue happened that everything, whatever the worst come to worst scenario we can imagine happened in my business. A lot of physicians, we know that income went down, some physicians passed away, some become disabled. Lawsuits are very common because COVID, they were, trying to treat a disease they didn't know how to treat. And every time new information were coming. So there was a huge influx we saw in burnout in physician community. So we talk about financial planning, talk about numbers only, but no one is talking about physicians' health, their mental health, how they're doing. When's the last time physician yourself went to the doctor? When is the last time, how mentally you're doing well? Are you getting burnout? And if you look at the statistic in Medscape, there's a huge suicide rate within the physician community, and no one is really talking about it, especially a young physician. They don't find this physician business that lucrative anymore. So Kevin MD is a good source. It's a social media where all physicians come in and voices their concern, what they're facing. And we are trying to incorporate these ideas, that these tough questions called behavioral science, into the financial planning, so we can make sure that they're overall happy, because there's no point of doing financial planning at the line in life if you're unhappy in life. What's the point of doing all of this? So that's why we try to understand other challenges physicians are facing, try to share the information with other physicians, and let them cope with the challenges they're facing mentally.
Thank you.
Yeah, no, this is very important because we don't really pay attention to ourselves a lot. And last year, even still unfolding, unfortunately, especially back home, it's really unfortunate that our
It is.
colleagues back home are going through such a horrible time.
It is.
So
Any questions?
let me see if there's any other questions. Grandchildren, can you pass on your trust or whatever straight to grandchildren? Are there any tax implications of skipping a generation kind of a thing?
Yeah, so you can create, it's called a general skipping trust. So most trusts are created in such a way. So the question is that, do you have to give it to the children and then from children to the grandchildren is necessary? No, you can create trust in such a manner that the trust remain intact, pooled. It just escape, bypass the children and goes directly to the grandchildren and the trust remain there is possible, absolutely. We do it all the time. It's called legacy trust. It is a part of the estate planning.
Alrighty, okay.
I just also want to tell all the participants that this is actually recorded video. It is going to be available. So if anybody is interested, please email us and then we should be able to provide that.
Yeah.
Thank you, Syed. It was a great presentation. Excellent.
Thank you. Thank you,
have
Dr. Chabra and Dr.
Chabra,
Malhotra and all the
great
RP
If
moderator.
community.
you can put up your slide about your contact information as we're talking, is there any of the final comments that are coming through? And just as a disclosure, of course, this is not a CME event. So just to put it out there. Usually Sunday mornings we do a CME event and we'll be having some speakers coming on. And so this is his contact information. You can call him directly, you can email him, and you can look at his blogs and stuff on the website. So cost segregation is for mixed use properties also, apartment buildings.
Yeah, cost segregation can be done as long as it is used for a non-residential purpose. You not live there, you are renting it out, or commercial unit, strip malls, anything can be done cost segregation. But just keep in mind the value of the property needs to be substantial enough. I mean, you should not do cost segregation for $100,000 property. We would like to see the value of the property close to $800,000. I'm just giving you a magic number, and that's what we see, because the cost of paying the cost segregation should be worth it.
Alrighty. So then there's another question. Through your crystal ball, are you reading the tea leaves sort of? Do you see the age of Medicare coming down anytime?
Yeah, we don't, Biden administration are not seeing the Medicare age going down. I mean, a lot of people, one option could be, so there are two, philosophy going on. One philosophy, increase the Social Security, but the question is, how are you going to pay all this bills? So we are seeing that people should work a little bit more longer. The overall census is. So, I mean, that's the only way you can just take care of it. Why, retire that early? So we don't see that the Medicare age is going down. It may just go higher.
Right. Okay. Thank you so much. Any other questions that were not answered, please post them here. And I see both Q&A as well as the chat boxes going, so I'm trying to address as they come along. But if there are no other questions, I guess thank you so much. And thank you everybody who joined in. And we had, how many people? We had about 40 people who joined in the in the attendees portion. And thank you so much. Thank you, Syed. Thank you, Abhay, for setting this all up.
Thank you, Dr. Chabra. Thank you, Dr. Malhotra. I appreciate your inviting us.
Alrighty, thank you. And how's the recording going to be available? Can we have that information also? If somebody wants to, somebody missed out and they want to have a recording of this.
Yes, we will send the recording to you and you can send it to your audience.
Okay.
And whoever registered, they will all get it within a couple of weeks, the full recording.
Thank you.
Thank you very much. Really appreciate this. Thank you.
Thank you all the participants.
Okay.
Thank you.
Have a good day.
Good day. Bye-bye.